just for to try to make fit all the topics that we have until the end of the semester. I sort of got rid of some of the chapters. Anyways, I think you guys have a good idea of consolidation. Chapters 4, 5, and 6 deal with minority shareholders or non-controlling interest. Basically, if we own less than 100%. So we don't need to worry too much about that. And we'll jump forward to chapter 7. So chapter 7, change gears here. We're looking at foreign currency transactions. The chapter also includes hedging foreign exchange risk. We are not going to be looking at the journal entries for hedging, but we are basically just have a basic understanding of the instruments and what are their purposes. So let's get started. Our first one is just an introduction to foreign currency and exchange rates. And I think, because of where we're located, we pretty much come in close contact with, foreign currency transactions. So we have, we either travel to other countries or we have, our tourists who come to Guam and they have their own currency, or we need their currency for going to their country. And we need to exchange monies because they don't accept US dollars. So we have come across, I'm pretty sure most of you are used to this, and you have exchanged currency once upon a time. But basically, sometimes we don't ask ourselves, how did this come to be? Between after World War II, I guess 1945 and 1973, a lot of countries where their economy was not as functional as what it is today, and so they kind of looked at the U.S. and the U.S. dollar and tried to fix their currency to the value of the US dollar. The US dollar at that point was based on the gold standard, but after 1971, the rates were allowed to float freely, and so that is what created a lot of the differences that we have today in currency values. So we can pretty much segregate these types of currencies, or how they are assessing their value of the currency, into three groups. We have the independent float. So the currency is allowed to fluctuate according to market forces, or it could be pegged to another country. Usually is the United States. So there's still countries who are pegged the value of their currency to the US dollar. And then the third group is the European monetary system, or the euro. So we have countries in Europe who are using one currency, the euro, and so that's our third group. If you're interested about exchange rates, it is a big investment. I'm not sure today, but another investment instrument in kind of taking advantage of these fluctuations and making money out of it. If you're interested in that, you can check rates, or just for the purpose of this chapter, you can go to the most visited, I would say, Oanda or X-Rates. Sometimes they want you to join like a membership or something, but just check if you're able to access it. And even you can just use Google, and you're trying to find out what is the peso today, and you just go and and search it, and you can find that out. But OANDA and X rates may provide historical rates. And if you notice, sometimes you go to a country, you go to the bank, and the bank may have a usually lower rate, exchange rate, than other places that you may find in that country. And the reason for that is because, of course, banks are trying to make money, and the banks are gonna make money out of the spread, the difference between buying and selling currency. So what we can see is there's two types of quotes. There's a direct quote and indirect quote. So the direct quote, we're asking how much US dollars do we need to purchase this currency. So if we were to buy peso, we would say how much do I need US dollars to purchase 1 peso. Okay, so that would be a direct quote. Indirect quote will be how many pesos do I need to purchase $1? So the other way around. I did upload it, or I'm going to upload another video, not mine, one that I used before from YouTube, that it kind of explains just in general terms what direct and indirect quotes are. So here's an example. This is kind of old, from 2015, but we can see, let me just get my pen here. Okay, we have a direct quote, so we're looking at the euro. So we're saying, we're gonna need $1.06 to purchase a euro, or we're gonna need 94 cents of a euro to purchase $1. Okay, so you can get the idea out of the direct and indirect quotes. Okay, this is just general, basic terminology when dealing with foreign currency. We need to know what is the spot rate. The spot rate is the price of the foreign currency for today. So if we're buying or selling pesos today, we need to find out what the spot rate is for the peso today, so that it's called the spot rate. Forward rate, here we're kind of getting ahead, but forward rate relates to forward contracts. And forward contracts are used to what is called hedging risk, because of these foreign currency fluctuations. We're going to have losses and gains on our income statement. These gains and losses are going to reduce or increase our net income. So we're trying to kind of smooth it out, these differences, and we can do that by using forward contracts. So the rate on that forward contract, it's called the forward rate. Hello. So basically what a forward contract is you're betting that the currency is either going to increase or decrease in value. We'll take a look at this a little bit later. A forward contract locks in the price. So today, how much do I think that the peso will be 3 months from now? Is the peso gonna appreciate in value or depreciate in value? Is I'm locking that price today. I'm betting on how the peso is gonna fluctuate 3 or 6 months from now. And just going back to this forward contract, we lock the price today. Another instrument is an option, and for the option, we have the option of exercising that price or not. So that's the difference between these two instruments, the forward rate and the option. They both is the same concept. We're trying, to smooth out differences from the foreign currency transactions. Okay, now if we are trying to engage or purchase a forward contract, if our forward rates exceed the spot rate, then that means that we are selling our forward contract at a premium. If the forward rates are less than the spot rate, we are selling it at a discount. I wouldn't worry too much about this. This is just FYI. But as long as you know what the forward contract is and what is an option, that's just basic information. This is in terms of options. This is the other choice that we have. If we are an exporter or importer and I'm dealing with clients paying in peso, or I have to pay in peso, and so I'm going to maybe engage in an option contract. So instead of a forward contract where I lock in the rate today, I'm going to enter into an option contract. So at the end of whatever period that option contract is valid for, I need to make a decision whether to exercise it or not. So option, I have the option to exercise it or not. Forward contract, I'm locked in, so there's no choice. So for options where we have a put option, I kind of think of a table. So if I put something on that table, that means it's for sale. But if I call something to that table, that means I want to purchase it. So a put option is a sale of a foreign currency. So if I got paid in pesos, now I need to sell the peso to convert it into US dollars. If I'm paying in pesos and I need to buy pesos, and that will be a call option. And then I have dollars and I want to purchase pesos. Okay, and so for options, we're talking about, instead of the forward price, we're talking about a strike price. So strike price is for options. Again, don't need to worry about too much, just a basic understanding of what option contracts are and what are their objectives. This is just, intrinsic value and time value is what we use to calculate this option premium. So basically, for the option, I have to buy the option. That purchase price of the option itself, of the contract, is called the premium, and that is a factor of the intrinsic value and the time value. Again, no need to worry. This is just FYI. Okay, so we enter into how are we going to handle these foreign currency transactions on our financial statements. And we're looking at what is known as a two-transaction perspective. So there's an accrual approach. First of all, we want to understand when exactly do we engage in these foreign currency transactions. So we may be exporting goods to other countries, and so they're going to pay us in foreign currency. We may be buying from other countries, so we are the ones that have to pay in foreign currency. Now, note that I'm saying that we're going to handle this in foreign currency. So if I was selling to a merchant in Philippines and that merchant is paying me in US dollars, we have no issue. We have no foreign currency transaction because they have already given us US dollars. So it doesn't matter where they are in the world, as long as we are paid or we have to pay in US dollars, there's no issue. This chapter is relevant when we have to pay in the foreign currency or we receive monies in the foreign currency. This is just an example that we're going to go into in just a minute. Let's just put a pin on this. So like I said, an export sale is, we are selling to others in other countries and they're paying us in a foreign currency. An importer, that means that we are buying from other countries and we are paying in that foreign currency. So under FASB ASC 830-20, this is the one that guides the foreign currency matters, and we are to adjust our accounts payable or accounts receivable and then recognize a gain or loss on our income statement. And I'll cover that in just a minute. Okay, so if I have an export sale, all right, so I'm selling to people from to other countries, to Philippines, to Japan, to Thailand, then I'm going to have an asset. That asset is going to be accounts receivable, okay, because I'm assuming I'm selling on credit. It doesn't necessarily have to be on credit. It could be cash. But I'm receiving a foreign currency. So if the foreign currency appreciates in value, I'm going to recognize a gain because I'm going to receive more than what we have agreed on, just because of the foreign currency fluctuations. If the foreign currency depreciates, then I'm going to receive less and therefore I will have a loss. And then the opposite is true if I'm an importer. If I'm an importer, I'm buying from other countries, I'm going to have an accounts payable, which is a liability. And so if the foreign currency appreciates, that means I'm going to have to pay more. And if I pay more, that is no good. And so I'm going to have to recognize a loss. But if the foreign currency depreciates, I'm going to have to pay less, which is good. And so I'm going to recognize a gain. So we need to understand, do we have an asset exposure? If I'm engaging, I'm an exporter, or do I have a liability exposure if I'm an importer? Just zooming through this, we're going to go to an example. So that's the main here. So we have assumed that we have an American company that is selling and shipping goods to a German customer. They have agreed on a price of 1 million euros. Okay. The goods are being shipped on December 1st, 2017. The payment will be received the following year, March 1st, 2018. So the spot rate, okay, so today's rate on December 1st was $1.32. So $1.32 for 1 euro, and we have 1 million euros. Okay, so since we're not going to receive payment until March 1st, then we're going to have to debit accounts receivable. And we're going to credit our sales. For now, we're just going to forget about the second entry, debiting cost of goods sold and crediting inventory. For now, let's just forget about that because we're concentrating on the foreign exchange. Now, how do we calculate this 1,320,000? That is our spot rate on the day on December 1st times the 1 million euros. And so now I have a receivable that has been converted to US dollars of 1,320,000 on the balance sheet. And I have sales of 1,320,000 on the income statement. Now, on December 31st, I'm going to have to adjust my balance of accounts receivable to reflect the increase in the spot rate. Okay, So December 31st is, I guess, our year end, and we're going to issue financial statements. So on that day, we got to check what is the spot rate for the euro. And in sub, that is $1.33. So the foreign currency has appreciated in value. And this works for me because I'm an exporter. So when I receive more monies, so I'm recognizing a foreign exchange gain on the income statement. And I'm increasing my accounts receivable to reflect the increase in the foreign exchange rate. Now on March 1st, this is when they're gonna pay me. The first thing that I need to do is check what is the spot rate on that date, because I may have to recognize a gain or loss. Unfortunately, the rate has decreased, so the foreign currency has depreciated in value, which is not good news for me. That means I'm gonna receive less of the amount that I had expected on December 1st. And so now we were at $1.33, and now we're at $1.30. So that means that I'm recognizing a loss of $30,000, and I have to decrease my receivable by $30,000. So how is this going to affect my accounts receivable T account? On December 1st, we increased it, right, to reflect the sales, recognize our sales revenue. And then on December 31st, we had to increase also because our spot rate increased by 1 cent. So that we recognize the gain on the income statement that increased my receivable to $1,330,000. Unfortunately, the day that the German customer is supposed to pay me, the rate has gone down, and now I had to decrease my receivable to $1,300,000. So $1.30 times our 1 million euro. It's hard to write with this pen, but you get the idea. Okay, 1 million euros. That's the total 1,300,000. That's how much cash I'm going to receive. So there we go. Debit cash for 1,300,000. Credit my receivable 1,300,000. That will zero out the receivable, right? Because that's our balance right now. So if I credit 1.3, this will zero out my receivable because it's gone. I got paid. So unfortunately, I was expecting to get paid 1,320,000, but I only got paid 1,300,000. Now, going back, if instead of being an exporter, I'm an importer, okay? I'm buying the merchandise from the German customer or vendor. If I'm buying merchandise, then I'm going to have an accounts payable, okay? I'm buying inventory, so I'm gonna debit inventory, assuming we're using perpetual system, and then I'm going to credit accounts payable, okay? On the December 31st entry, since the currency appreciated in value and now I'm an importer, that is not good news for me because that means I'm going to have to pay more. I'm going to have to pay 1,330,000 instead of 1,320,000. And so if I was an importer, this will be a loss. I will have a foreign exchange loss, and then I would credit accounts payable. So that would increase my payable. And then on March 30th is actually good news for me if I was the importer, because the rate had decreased. And so that means in this case, I would reduce my accounts payable and I would credit a foreign exchange gain. So my last entry would be a debit to accounts payable for 1.3 and a credit to cash for 1.3. So that should be mirror images for the exporter and the importer. Now, if you noticed, we would know, if we're looking at it from the income statement, in 2017, we would have a gain from the foreign exchange currency of 10,000, and then the second year we would have a loss of 30,000. So we have this fluctuation. We increased net income in 2017 by the 10,000, but then we decreased it in 2018. So the purpose of hedging is to reduce that risk, that fluctuation. And as I said before, the two instruments that we can use is the forward contract and the options. Okay, so forward contract and options. So that's the purpose of the derivatives, is to reduce the risk from the foreign currency fluctuations. Right, so that's pretty much completes chapter 7. We're just concentrating on the importer and exporter entries. You don't need to worry about hedging the cash approach or the fair value approach, none of that. Okay, so that hopefully simplify matters for you. Okay, so and make sure to comment on the forum, the Q&A in Moodle. You have until Monday to post your questions, and then one of your classmates should respond to your questions by Wednesday. So you'll get 10 points for posting on Monday, and then another possible 10 points for responding by Wednesday. And then on Monday, of course, we have our Big Blue Button meeting in Moodle, and we will be covering some of the exercises that I'll be posting in Connect. Okay? All right. So I'll see you guys Monday. Have a good weekend.